Good afternoon and welcome to Managing Your Money, tips on personal finance, career issues, and taxes. Thank you for joining this Barron's call today on the new rules of retirement. I'm Beverly Goodman, Editorial Director for Investing and Asset Management at Barron's, and I'm on the line with Patty Brennan, the President and CEO of Key Financial, and also one of Barron's top advisors, and someone I just love talking to. Welcome,
thank you,
Patty.
Beverly.
Thanks so much for being here.
Thank you so much.
Great.
What an honor and a privilege, and what a wonderful opportunity during a difficult time in our country to be able to talk with everybody and answer questions and kind of put everything in perspective.
Yeah, so we've got a lot on that front. So let's try to get through some of the top concerns about people thinking about retirement, whether you're in retirement or you're just getting close and planning, or whether you're just like younger and planning ahead. If you've got any kinds of questions, feel free to write in, folks. Let's just start kind of broad here. Asset allocation, like people have watched the markets go crazy, right? I mean, some people's stock portfolios fell 30% in a matter of weeks. We've seen a pretty healthy rebound, but obviously not back to where people were. How should people be sort of thinking about investing in this kind of time of uncertainty? Is it a time to dial down risk or take on more risk, hold more cash? A little bit of a framework, Patty, for how people should be thinking.
Sure. So let's first acknowledge and thank the wonderful long bull market that we had for 11 years for its, acknowledge that it's over, and we thank it for the businesses that it helped to grow, the dividends that it shared, and the wealth that it created for so many people who are hopefully listening today. Just because the bull market is over doesn't mean that we need to change everything. Bear markets really don't destroy wealth, Bev. It's how we react to them. It's how we respond that can actually destroy them, or, as you were alluding to, maybe even create more of it. So we don't necessarily want to change everything, change our asset allocation because of something that, unfortunately does happen from time to time. The fact that we hadn't experienced something like this in a really long time, 11 years, that's really the aberration. That's really the thing that's out of that's not normal. So bear markets are normal. We have to accept them. For people who are approaching retirement or in retirement, you've got an asset allocation. Your asset allocation is there to serve your needs. Your money that you've accumulated over a lifetime is there to create cash flow for the rest of your life. And your asset allocation and how you divide it in different types of investments, that's done in a way to be able to do that no matter what's happening in the world. So when markets are going well, everything's hunky-dory, you get your cash flow. When things aren't going well, you simply go plan B and rely on safer and more secure investments, because you certainly don't want to be selling during a period like this. Does that make sense?
It does. And, one thing that I've kind of always thought, I tend to be a little more conservative myself and probably always, even in great times, hold more cash than some people have said I should. But, you have to understand your own risk tolerance too, as you were saying. And it's nice to have kind of that extra cash cushion to know that if something bad does happen, you don't need to make dramatic changes in your stock portfolio. You can have a little time to write it out, even if you are retired. We are getting a few questions from people in their early 60s. A couple of them have specified.
The red zone. They refer that.
Yeah, exactly. So they're asking, kind of generalizing among a few questions here, basically what level of risk is appropriate. Do they want 50-50 stocks and bonds, 60-40? Do you still do kind of like hold your age in bonds as a percentage? I mean, obviously, this depends on your own personal situation, whether or not you have a pension, how much cash you have to get you through the next couple of years, that kind of thing. But, generally, Patty, what would you say to these people?
It's a great question, Bev. It's one I get all of the time, and it's a really important question. To me, there are two aspects to risk. Number one is your tolerance, and I would submit that a lot of people don't really know what the risk tolerance is until we're actually in it. I've had people. Yeah, you know what? It's easy to say, yeah, I'd be okay losing 10 or 15%, and then when I apply numbers to that and say, well, in your case, that means $50,000. Are you okay losing $50,000 in what, in this example, was in the span of a week or two? Gone, evaporate into thin air. And all of a sudden people say, well, wow, that's different, $50,000. I mean, that was a whole year's worth of income for me. So that would be number one, is to really understand what volatility can really mean in terms of dollars. The second thing that I think is a lot more important, it's something that you were exactly alluding to, Bev, and that is, what is your risk capacity? In other words, if it did happen, or actually, let me say this, when it does happen, would you still be okay? In other words, would you have to go into your 401k in order to cover your mortgage? That is a low risk capacity in my book. Or do you have a lot of money that's sitting in a bank, that you haven't touched in 10 years, and it's just been sitting there earning 0.5% the whole time? Well, someone in that situation has a very high risk capacity, because if their other account were to lose 30%, well, they've got that money in the bank that they can go to, so their capacity is much higher. Other factors that go into risk are, to me, one of the biggest things is, how much money do you need to pull from your portfolio every month to live? So that 30-year-old who may be listening right now may have a much higher risk capacity because they're working. They've got a secure job. They're an essential worker. They don't have to worry about losing their job. And so from a cash flow perspective, they can leave this money alone because they don't need to touch it. So risk capacity is, to me, even sometimes more important than risk tolerance, because if you don't have the capacity, and that's not a judgment. It's just life. It's, what are your resources? What do you have available? And so let's just frame that, because if the risk capacity isn't there, you can have the highest risk tolerance in the world, but it could be a losing situation. It could be a really precarious situation. So to your point, everybody's situation is different. If you're approaching retirement and aren't sure about how much you're going to need to pull from your portfolio, when in doubt, go on the more conservative side, because you can always add to equities at any time once you're actually retired and you get a better sense of what you need to rely on. So that person who might want to go 60-40, for example, let's start out at 50-50 and then kind of see how things go. And assuming that everything's going fine and we know the cash flow that you need to pull, then you can ramp it up a bit. Make sense?
Okay, totally. We're getting a bunch of questions. One that I think it encapsulates a few questions, so it probably covers a lot of what's on readers' minds out there. In the current climate, would you recommend investing in mutual funds in addition to maxing 401k and profit-sharing contributions? Or is it better to select a set of large cash-heavy companies to invest in, or just keep as much as possible in cash for now, or something else? This person's 44, partner's 52. I mean, we at Barron's, and really everywhere, I mean, I think this is where conventional wisdom almost always holds up. Max out your 401k, right? Like that's first, especially if you're getting a corporate match. That's free money.
Yep.
The money goes right into the account before taxes, so you get that nice tax break. You also get the behavioral benefit of it just sort of happening, without you managing it. With regard to what to do beyond that, whether investing in mutual funds or individual stocks, Barron's has written a lot about investing today, and we have recommended that if you're going to choose individual stocks, you do want to look at companies that have really strong balance sheets and that have the cash. Like individuals, companies need to manage their finances so they have the cash to get through some tough times like we're in now. That said, I don't know, Patty, what are your thoughts? Do you tend to put clients into mutual funds, or do you do a lot of stock picking?
It's a really great question, and I agree 100%. If you have the time and the aptitude to really look at the balance sheets and understand the corporate finances, I think it's a terrific alternative. The only thing I would caution everyone about is that here we are in the midst of a bear market, and a crisis, and a lot of companies that anybody would have said, hey, that's a great company. Safe, solid. You take a Boeing, for example, or the airlines, or the oil companies, for crying out loud. These are huge companies, blue chip companies, and they're really having a difficult time, and they're bleeding through all of the cash. So I think that it is one. It's something that you want to be very careful about. I think you need to know, and you need to be able to be very agile, especially when things come out of the blue like this, which is usually what happens. And if you don't have that, then I do recommend go with an index fund, a low cost index fund, or a mutual fund. I think that strategically, that's a tactical decision. In other words, do I go here or there? Do I do individual stocks, mutual funds, ETFs, et cetera? A strategic question goes back to your point, Bev, and that is the 401k. And I would take it one step further for this listener who's 44 years old with a partner in their early 50s. And that is, should they do a pre-tax 401k or an after-tax or a Roth 401k? If you do have the Roth option, think about where you are today, what your tax situation is today, and what it might be in the future. Because I don't know about you, but I have a feeling that somehow, some way, we're going to have to pay for all this. And I think that the way that's going to have to happen are higher tax rates in the future. So think really clearly about what your situation is today and what it might be in the future. Of course, nobody really knows. That's the thing about all of this. And that's even, with our leaders. We have to make imperfect decisions when we have imperfect information. It's a judgment call. Yep. So you just look at your situation, and everybody's situation is different. But definitely 401k, then, Roth versus regular, and then a second thing that you might want to think about, and again, it depends on your income level, is think about doing Roth IRAs. Even if you have access to a 401k at various income levels, you could throw money into a Roth, and that's a home run because that goes tax-free.
Yeah, that's an excellent point, because I think even this current economic crisis notwithstanding, we have been at historically low income tax rates for a long time now. Yeah. And I think if you're on the young side and you're not looking at touching this money, if that's measured in a decade or more, multiple decades, I think just sort of naturally we're destined for higher tax rates at some point in the future. And you're right, given what's going on now, we are going to have to pay for it. So a Roth Roth IRA makes a great idea. And you also covered, without realizing it, I think, a couple of other questions we've gotten on index funds. Mutual funds definitely make things a lot easier than stock picking. You've got the benefit of diversification. You've got the benefit of, professional management. Index funds are cheap and in some ways even easier. One person's asking about Warren Buffett's advice on putting 90% in an S&P index fund, 10% short-term U.S. Treasury bond, and leave it alone. I think for this person who's in their early 30s, that's a pretty good allocation, right?
Yeah, absolutely. It can absolutely be a good allocation. I think that, the beautiful thing is about the index funds is you don't have the human element of, again, poor decisions. We are all painfully human, and as such, even professionals can react. I think of, people even in my own field. I was surprised to hear somebody that I've admired and respected for many, many, many years move their clients into cash in the middle of March, and I was really surprised. By the way, Bev, you probably know this. I do not believe, I have never felt that it's a good idea to sell when everybody else is selling. It's just never been a winning strategy. And I would also say that, in all the years I've been doing this, and I'm, you can't see me right now, but I've been doing this for a while. You don't have to predict the future to win this game. So, and I want everybody to kind of itch that into your big, beautiful brain, because it's important. It's really important. We don't have to try to predict the future. As Warren Buffett said, 90% in an S&P, 10% in a Treasury. That can work as long as you don't tinker with it too much. Now, I will say that index funds have certainly, on average, outperformed the active managers. And active managers cost money. It's people. It's human beings, right? I would also submit that just because I can't dunk a basketball, it doesn't mean that nobody can dunk a basketball. I'm just 5'3", and it's just not going to happen, right? So there are some people out there that that can be gifted. Also, keep in mind that there are different types of index funds. I do wonder if we ever get to the point that because a lot of money is going into index funds, whether it's becoming kind of a self-fulfilling prophecy, and because the S&P 500 is something called a cap-weighted fund, which in English basically means that the bigger companies, the Apples and the Googles of the world and the Walmarts, because it's market cap weighted and they're so big, they're going to get more of your money that you invest in the S&P 500, right? So are we creating kind of the self-fulfilling prophecy where the big are just getting bigger because we're plowing more money into them? And at what point could that ever become a house of straw? I'm not suggesting that it will be, but I would suggest that perhaps a thoughtful approach to indexing might be a good idea. Indexing based on what a company is earning, for example. Well, that kind of makes sense to me, right? You give more of your money to the more profitable companies, or even dividends. So there are different ways to index, and I just would encourage people who are listening to look at the different ways of getting that benefit of diversification in a more thoughtful way.
Okay. I want to get to as many questions as we can. So one person, this kind of harkens back to what you were saying earlier, says, good point on risk tolerance. It's a couple in their early 60s. They have a year of their expenses in cash, and they have a taxable portfolio equal to another 3 months. I'm not sure what that's invested in. And they're asking, do I transfer more bond assets to stocks in our retirement accounts during this buying opportunity? It feels maybe a little early to me. I don't think there's a rush to get in, but maybe you have other thoughts. I also think, it's getting back to what we've been saying about risk tolerance, like it's good time to take a hard look at how you feel about 1 year of expenses. Some people, especially in times like this, may want a little more. So instead of
Mm-hmm.
putting money into the market, you could take some of that bond money and maybe put it into cash or short-term bonds. What do you think, Patty?
Well, first of all, I think that whoever this listener is, I give you so much credit because it takes courage to invest when everybody else is selling. You know, it's markets like this. I mean, let's not fool around with this. I mean, it's markets like this can pose a real danger to everybody's financial health. And the danger is not so much in the drop itself. The danger is what we do while it's happening. And this listener is saying, well, wait a minute, if this is temporary like all of the other ones have been in the past, is it a good time for us to invest in it? And to your point, Bev, I think that we do want to be thoughtful about that. I'm never going to be able to time this stuff right. I am never going to be able to do that. I you know, to me that's a you know, a loser's bet, and I think that that's where the gambling metaphors do tend to come in, because you know, in the end, I could be right one time or two times, but I know that if I stay at the table, the house is going to win. So really looking at your situation, now this is a retirement account that we're talking about. Again, it's a time thing. What you might want to think about, and I'm thinking in terms of the listeners, is to think about your money. You think about your invested assets in kind of three pools of money. So pool number one would be the money that you need for the next 3 years. So you've got 1 year in the bank and another 3 months in after-tax money. And I'm not sure if these people are retired or not, but they're approaching retirement. So think about it in terms of risk and time, because that's what risk is all about. Eventually, we do come out of bear markets. It's a question of when. In other words, peak to trough, okay, the average is 9 months, right? So from beginning to end, on average, it's taken 9 months. How long does it take to go from the bottom to the recovery, back up to where it was before it all happened? If we go back to the financial crisis, that was about 3 years, peak to peak. The tech bubble was actually longer. That was closer to 5 years. So you want to know that if you're going to be putting that money in the retirement account into stocks, just to play devil's advocate, I'd want to know that you don't have to touch it for 5 years. That would be pool 2 money, okay? And then pool 3 money is your long-term money. That's money that you're good 7 years and beyond. So pool 1, first 3 years, pool 2, from 3 to 6 years, pool 3, 7+ years. And you allocate your money in terms of risk in those 3 different pools.
That is such a smart way of thinking about it.
Yeah. And then it's personal. That's personal. Then it's for you. You're not again. If I will tell you, Bev, and you know this because I'm such a fan. Barron's does such a great job educating the reader. I got to tell you, it's the one that is just, it's a must read every week. And I think that by doing so, you're educating and taking this complicated world of investing and making it real for people who are reading the magazine as well as listening on the phone today. So just kind of keep it simple in terms of applying what you're reading about to your personal situation.
So we only have a few minutes, Patty, and I think we have time for maybe just one more question.
Sure.
We're getting a couple of questions around dividend stocks. So one person just asked bonds versus dividend-producing stocks. I think it depends on what exactly you're looking for. Obviously, a risk of dividend, if you're looking for income, a risk in dividend stocks is that companies can and are starting to more frequently cut their dividends, which leads us right into the next question. How do I explain to my mother that a high dividend yield does not guarantee that the yield will continue going forward? So, Patty, as an expert educator yourself,
right.
Can you just go, talk a little bit about what you get from bonds versus dividend-paying stocks, and also, simply so we can all understand and explain it to others. And, maybe just sort of generally, if you have
Sure.
thoughts on how we can just talk to our
Sure.
parents about this stuff.
Sure. So let's kind of break this down to fundamentals. What's the difference between stocks and bonds? So stocks represent ownership, bonds represent debt. If I have stock in IBM, I own a percentage of that company, whatever percentage that stock represents. And because of that ownership, I get to participate in their profits. Think about it almost as rental income, okay? If I have a bond, a corporate bond with IBM, I have lent, let's call it $10,000. I've lent IBM $10,000, and for that loan, they're going to pay me 3% per year. Now, from IBM's perspective, they, as the corporate, they have to pay off their debts before they pay off their shareholders. So if cash flow is tight, and many of these companies, to your point, Bev, they're not getting revenue. If they're not getting income, look at the airlines. They have no revenue. So they've got to make a choice. Who are we going to pay? Well, we have to pay off our debt before our shareholders. They're higher up on the capital structure. So in that case, guess what? They're not going to pay their dividend because they have to pay their bond. They have to pay their loans. So that's the way I would explain it to, in this case, your listener's mom, to say, Mom, just because they have a dividend today doesn't mean that they're going to be able to continue paying it, and nor do they have any obligation to do so. They do have an obligation to pay off their loans, though, because if they don't, nobody's ever going to loan them money ever again. And that's the decision they have to make. So when you're thinking about this, just keep that in mind. Now, we have a situation, interest rates are very, very low. So I would understand, hey, why wouldn't I invest in a stock, or if I may say, please, a diversified portfolio of dividend-paying stocks? Why wouldn't I do that instead of a bond? Because I could get the same income and I get to participate in the upside if and when stocks recover. If that's a strategy that you're considering, that might work just as well, or maybe even better long term, as long as you can stomach the volatility that's going to come with that portfolio. Because if you can't stomach the volatility, if it just makes you too nervous and you'd be inclined to sell, that's not a good strategy. But to your point, dividends are probably going to be going down. We have to recognize that, and we have to understand, how much you need to rely on that stream of income, because it is like rent. People can stop paying their rent too.
Yep, and I think one other point to make that I think you might have gotten to quickly or alluded to, but when you're just looking at a stock's yield and price are a function of math, basically. When a company's stock price falls, it looks like the yield is going up, but they're not necessarily paying existing investors more money. In fact, it could be a sign that payment, that dividend payment, is in trouble. So if you're looking at stocks for the income, it takes like a little extra research. And I don't know if this reader wants to help their mom with this, or if you can steer them into maybe, as you noted, a diversified equity income mutual fund that will be probably a bit safer. So I think
that is such an important point. Yeah,
thank you, Patty. Patty, this has been great. Unfortunately, that's all the time we have. We did not quite get to all the questions, but hopefully our readers have gotten some great information from you, and we'll have to have you back to cover the list of things that we didn't even get to that you and I cooked up.
Thank you so much, Bev. This was fun.
This was great. So, folks, join Barron's Live tomorrow at noon to hear Barron's Senior Managing Editor Lauren Rublin and healthcare industry reporter Josh Nathan Katzis discuss the latest developments in coronavirus testing and the companies that are working on the most promising treatments and vaccines. And hopefully we'll also see you back here next week. Thanks very much, everybody. Stay well.